Good morning. Welcome to this session on project finance. So for session review, business question three as the focus of the review questions. Question three is our focus for this first session. In our next session, look at question four, question five, and so on and so forth. So let's start with question three. The beginning part of this question is theoretical. The A, B, and C part are theoretical. Question D dives into the quantitative aspect now. So now, question 3A reads, what is the project finance plan? So the project finance plan, in simple terms, is simply, it refers to a structured financial arrangement designed to raise funding for a specific project. For instance, power plant, mine. Just a moment. Okay, so now we mentioned that the project finance plan, right? It's simply a structured financial arrangement designed to raise funding for a specific project. Now, in this case, the repayment is primarily based on the future cash flows generated by the project, rather than the creditworthiness of its sponsors or owners. So this particular method uses a combination of both debt and equity, and is often arranged under what is termed as an SPV, a special purpose vehicle.
Sorry, Steve, excuse me.
Sorry? Yes, sir?
So maybe you're going to provide the notes for these answers so that we can refer to them afterwards because we are not able to write. Are you going to provide some?
Yes, I will. Yes, I will.
Okay.
Yes, I will provide some notes for these answers. So I'll provide notes for the answers, but then for the quantitative part, I will see if I can provide something. But for the notes, these answers, I'll provide some notes for them. Yes, so now, the purpose of the SPV is to isolate financial risk. So we define what a project finance plan is, right? Now, what's the importance of it in project finance plan? What's the importance of it now? The importance of it primarily is that it's good for risk management. So the plan itself allocates and mitigates risk across the different parties involved. So as such, it ensures that each stakeholder bears risks they are best equipped to manage. Secondly, it's good for capital mobilization. So it helps us secure both debt and equity financing by presenting a clear and viable strategy for funding and other operations, which makes the project attractive to investors and other financial institutions. The third importance is that it's good for the cash flow forecast. It's cash flow forecast. So since the repayment depends on the project's cash flow, the plan ensures that the income streams are adequate, predictable, and reliable, which reduces the dependence on the balance sheet of the parent company. So these are the major important aspects of the project finance plan. Now let's look at part B. Part B simply states that outline the principal objectives of project financing plan that you're setting up for a client. So in setting up the project finance plan for a client, the key objectives are you're trying to secure adequate funding. That's the first thing you're looking at. You're trying to secure adequate funding. So you need to ensure the project itself, right, receives optimal capital from the mix of sources to fully implement and operate the project. Secondly, you're trying to structure the financial risks appropriately. So in doing so, you're designing a risk-sharing mechanism among parties, which in turn protect the project's long-term viability. The other objective of this is now you're trying to achieve financial viability. So you're trying to ensure the project's financial metrics, for instance, the internal rate of return and net present value, as well as the cost-benefit ratios, they're attractive and they're supportable, which will enable the project to service debt and generate returns for equity investors. And lastly, you're trying to comply with the legal and regulatory requirements. So the finance structure should be compliant with national laws as well as international lending standards as other ESG requirements, the environmental and social governance requirements in this case. And that's how we tackle part B. Now, let's look at part C now. Part C says, so A, B are done. Now looking at part C. Part C says there are several important factors and issues in designing the design of the financing plan for the project. So briefly list and explain 5 of the issues that are considered when designing a financing plan. So this question is posed to you. What issues can you encounter in designing a financing plan? What issues will you encounter in designing a financing plan? Anyone?
Of course, the first one is the capital, where the capital will come from,
Exactly.
and also maybe who's going to bear the risk if maybe the project doesn't succeed.
Yes. Exactly. Madam Gladys, what about you?
I think what is given is what was on my mind as well.
Okay, Mr. Sogo, sir.
Maybe market conditions as well.
Yes.
As well as the legal frameworks.
Just a moment. So yes, generally that. Now, the major issues that you face, like you just mentioned, right, are firstly capital structure. So determining the right mixture of debt and equity can influence the risk and return because more debts may reduce the equity requirements, but in turn increases financial risk. More equity would dissolve the ownership of a particular project. Secondly, you have the cash flow projections as the other consideration that you look at now. So cash flow projections now, in this case, you need a more detailed and realistic projection of revenues and expenses is essential. Because if you project your revenues, you may find that the expenditures overweigh the revenues. In that case, your project is going to be non-viable. So it helps determine the debt capacity and the expected internal rate of return and other repayment abilities now. The third thing that you look at here is the lender requirements. So you consider covenants, interest rates, and other conditions which are imposed by lenders to ensure the plan remains bankable. Third, the project risk profile. So assessing the construction and operations as well as the environment and the market's risk is critical, right? The risk itself. Because now you have to conduct risk mitigation through insurance, through guarantees, or government support in this case. Or government support in this case. Now, those are the first 4 things. Now, the fifth one is the regulatory and tax environment. That's what you consider also. So now, on that element, the plan must consider taxes. The plan must consider taxes. Also, must consider taxes, the incentives, subsidies, and the regulatory permits. Because these are actually directly they have a direct effect on the profitability and the cash flow of the project. And that's how we handle this particular question C. Any questions so far? Are there any questions so far?
No question from me.
Okay, so maybe from my end, I think what I've observed is it's like when we talk about B and C, the answers are a bit similar.
Yes,
to what we are looking for, principal objectives and what we consider.
The issues, yes. They're quite similar, yes. The issues and the objectives are quite similar because in the objectives, they're trying to avoid the issues in the objectives, right? Whereas in the issues, you're now addressing them directly. So the objectives are meant at avoiding the issues, whereas now the issues are actually just meant at just addressing them there. In that case, are we okay?
Yes, we can proceed.
Okay. Any questions from William But? Let's look at Part D now. So it says in country Y, there has been significant activity in mineral exploration and mining activity. The Rocky Mountain Mining Corporation has successfully acquired a license to embark on a new mining project. The company intends to utilize a combination of long-term debt and common equity financing. You have been hired as a consultant by the CEO to assess and estimate the borrowing capacity of the project in question. You begin the exercise by setting up a framework for the project financing plan. So here, question D is broken down into multiple questions because now it breaks all the way down up until the quantitative aspect. So it starts with the qualitative part for question D. So it says outline the principal objectives of the project financing plan and setting up for the client. So again, it's similar to what? Part B here. You're not seeing that? It's in the pattern. Are you seeing that? It's similar to part B in the other part there. Are we okay there?
Yes.
So this one is just in the form of a case study. So what are you trying to do for your client in this case? The principal objective for the client is that we're trying to outline the objectives given here, right? Align the objectives here, apply the mining project. So we're trying to mobilize funding first to launch the project. That's the first thing we're trying to do. Second, we're trying to minimize financial risk exposure to the parent company by ring-fencing liabilities with the SPVs. And then thirdly, we're trying to ensure repayment of lenders through predictable future mining revenues. And lastly, we're trying to support sustainable operations over the horizon, project horizon. That's the first part. That's the first part of this question now. Now it says, in the context of this consultancy work, explain the term borrowing capacity of this project. So what does borrowing capacity refer to? Borrowing capacity simply refers to the maximum amount of debt a project can support based entirely on the projected net operation cash flows. Is that part clear? Are we clear on that statement there? Are we clear on that statement? Are we clear there?
Just repeat.
So I was saying the borrowing capacity just refers to the maximum amount a project can support based on its projected net operation cash flows. So this is a measure that a lender will use to determine how much they can safely lend without risking default. So your borrowing capacity is influenced by three things: the project revenue and expense pattern, that's the first influence. Secondly, the interest rates and the loan tenure. And lastly, the required debt service coverage ratios. Any questions on that one? Any questions on that one? Any questions?
Okay, clear from my.
Okay, lovely. So we've handled this part here now. It says mention two ways in which the banks mention two ways in which borrowing capacity can be estimated by banks. So majority of banks just use two things. They use the present value of net cash flows, and then they also use the debt service coverage ratio, the DSCR, debt service coverage ratio, as a measure of this. So let's look at question 4 now. Question 4, part 4 now. It says, one of the top managers has provided the following information on the variables. So R shows the cash revenue in the first full year. E is the cash expense in the first full year. C is the non-cash expense deductible for tax purposes. T is the tax income rate. GR, annual growth rate of cash revenues. GE, annual growth rate of cash expenses. I, interest rate on debt. K is the cost of capital. N is the life of the loan the company intends to get measured at the date of completion. Now, furthermore, we're given this. R is 150,000. E is 26 million. The growth of revenue is 5% per annum. Alpha is 1.5. C is 0, I is 10%, T is 40% tax rate. The growth of expenditure is 5% or so, N is 12 years. So now, with that in mind, we're required to find the present value of the present value of the cash flow of the project here. How do we do such question? Just apply the same formula given to us here. So already given the formula, by the way, which makes it easier for us to do our job here. Are we all following? Are we all following so
Yes.
far? All right,
Yes.
let's now get solving the question then now. So I'm saying present value is given by, so PV is given by, we go back to our formula here, it's equal to 1 minus the tax rate applied by R minus E over I minus the growth rate of revenue, I minus the growth rate of revenue, then all this multiplied by 1 minus 1 minus, let's go back here, 1 plus the growth rate of revenue, 1 plus G of R over 1 plus I. All this is together here, raise the power N. Are we all on the same page so far? Is anyone lagging behind on how the formula is? Are we following?
Yes.
Okay, so now we're given all these conditions here. So this is equal to 1 minus tax rate is 40%. So 40% is just going to be 0.4, right? 1 minus 0.4 here. Multiplied by our R is given to us as 150. R is 150. R is 150. And then let's go back here. R is 150. It's supposed to be 150 million. Expense is 26 million. So R is 150 minus 26 here. And over 1 minus the growth rate of R, which is 5%. Growth of R is 5%. 1 minus the growth rate of R is 5%. 1 minus the growth rate of R is 5% here. So growth rate of R. Oh, I minus GR, sorry, I minus GR. I minus GR, so I is 10%. This is 5%. So I'm going to say 0.1 0.1 minus 0.05 multiplied by 1 minus 1 plus 0.05 over 1 plus 0.1, and all this raised to the power 12 years. Are we following how this is coming up? Are we on the same page? So this is going to give us 0.6 times 124 over 0.05. Are we following? Is anyone behind? Is anyone behind? Is anyone behind so far?
Okay.
Okay, lovely. So now multiplied by 1 minus, these two will give us 0.9545 here. Raise the power 12. Yes, sir, we're going to get 0.6 by 124, will give us 74.4 divided by 0.05 will give us 1488 times 1 minus 0.9545 to the power 12 will give us 0.5189, which now be equal to, in total, 1 minus answer 10 times 1488. We are getting $637 million as the present value of this. Any questions on this part? Questions? Questions so far? Are we clear on this part?
It's clear.
I'm Gladys, Mr. Soko, are you following?
Okay,
Yeah.
for me, I'm just trying to go through using the calculator. So I'm just trying to go through.
Okay. Mr. Soko?
Clear.
All right. Okay, so this is how we solve part A, part 1 here. And keep in mind, imagine this is just 2 marks. Just 2 marks, just like that. Just 2 marks. Okay, let's proceed then.
Just the interpretation of the amount that we found.
Sorry?
I'm saying just the interpretation of the amount that we found from the scenario that we are given.
Yeah, what I'm given a scenario, the present value is just 2 marks. Find the present value of the cash flow, just 2 marks. That's it.
So I'm saying, what's the interpretation of the same amount?
Just this is the present value of the cash flow of the project. This is the present value of the cash flow of the project. It's the present value of the cash flow of the project. That's all I'm saying in this case. We're only interpreting the next one now, the maximum amount, that maximum borrowed amount, which we're trying to interpret now, this case. For the next one. So now saying part B here says calculate the amount the project is capable of borrowing. So I look at the maximum loan amount. So I say maximum loan amount is given by this formula here. This here. So it says it's given by D0 is equal to PV over alpha. PV over alpha. So which in this case, the present value is the one we found previously here. So if this one is not okay, everything else becomes a bit shaky. So now, this is the 3-mark question. And then because we have to interpret it, solving is just 2 marks. Interpretation is the other part now. So this is going to be equal to 637 over alpha. What's alpha? Alpha is 1.5 here. Are you able to see it? Over 1.5 here. This just give us 40. Sorry, yes. Okay, so I'm saying it's to give us 424.69 million dollars. So what does this translate to now? What does this mean for us? This means that the project can only support up until, let me try this down here. You can interpret saying the project it only supports up to 424.69 million dollars in borrowing while maintaining a DSCR of 1.5. Are we clear here? Are we clear here? Are we clear? This is our interpretation here. Not just any, by the way. It's our interpretation. Are we clear? Is anyone behind so far? All right, so far, thank you. Mr. Whether, are we clear so far?
Yes. So the DSCR, where is it? We are given, or
Yes, we're given. It's the alpha. The one we're given as alpha here.
so? Okay. Now, what does DSCR stand for? It means what?
It's the debt service coverage ratio. Debt servicing coverage ratio. It just shows how much debt you can take out.
May I just ask something as well?
Yes, go ahead, please.
Okay, if I were to write to say the project can only support up to 4,024,000 in borrowing while maintaining an interest rate of 10%, would it be wrong?
That's a bit tricky because, okay, the debt service coverage, right? This 1.5 is in there. It signifies the interest plus the principal. So
okay, so the alpha in short denotes a ratio which concerns debt.
Yes, we consider debt because it tries to look how banks look at the ratio of net cash flow on your debt service. So it's just basically cash flow over annual debt service. That's how you find the DSCR, but it's given to us most cases.
Okay.
Yes.
Thank you.
All right. Okay, let's look at part 5 now. So we've done everything here. So answering the question on this one is 2 marks. Interpreting is another 1 mark. That gives us 3 marks in total here. So it says, part 5 says, suppose the sponsors would like to know how much revenue the project would generate in the first full year of operations, when the indications are that debt is what? 350 million. Calculate this revenue, knowing fully all that the following holds. So given the formula for revenue here, what total revenue is equal to? R will be equal to, just a moment. R will be equal to alpha times D multiplied by I minus the growth of revenue. All this over 1 minus the tax rate T multiplied by one minus 1 plus G R over 1 plus I, and everything raised to the power N. So I'm trying to find this here, right? Now, we're already given all these conditions here. Price has 3 marks. But now, alpha was given to us as 1.5 times D. D is given to us as 350 million in the question itself. $350 million as the D there. $350 million as D. It's given to us there. So if D is that, what I was saying, multiplied by the difference here. We already found this difference here. The I minus G. We found this as 0.05, so times 0.05. We already found this in the first question here, the denominator here. We found that here last time. So we're just moving there now we had initially. So I say 1 minus 2 multiplied by this. Once again. Okay, so now we're saying here, 1 minus t. T is 40, so it's 0.6 here. Because t is already 40%. So 0.6 is 1 minus t times what's inside here. Now what's inside here? We found this earlier on. We found all this here earlier on. Remember that? You recall? We found all this last time. So I'm saying 1 minus 0.5189 multiplied by 1 minus 0.5189. We found this area one, which will now be equal to our numerator 1.5 times 250 times 0.05 will give us 26.25 over 1 minus 0.5189 multiplied by 0.6, so over 0.28866. So saying 26.25 divided by our answer, we're getting 90.94. 90.94. So let's translate this to just as at our revenue level. Okay, let's see this one. Let's go back to this part here. Or plus E. We forgot to add the expenditure here. Plus E. Plus E. Plus E. My bad on this one. So plus E here. And plus E. Plus E. Now plus E. What's E in our question? E was given to us as what? 26 million, right? So I'm saying plus 26 here. So plus 26. So plus 26. I'm getting 116.94 million as the revenue the project needs. So translation for this, we're saying that the project, translation for this, interpretation for this, we're saying the project needs 116.94 million 194 million in year one, in revenue in year one. In revenue in year one for it to service a debt of 350 million. Are we clear here? Are we clear here? Are we clear?
Yes. Then maybe why are we getting the 1 year? The one that we've interpreted that the project needs that in 1 year.
No, it's been, the question was specific. It says that the question just said, suppose the sponsors want to know how much revenue the project will generate during the first full year, first full year operations. It does specifically tell us that. It's quite specific on this part.
Okay, thank you.
Yes, thank you, sir. Okay, glad you're following. Let's look at part 6 now. Part 6 says, suppose the expected growth, long run growth rate of revenue is 3% rather than 5%. So growth has changed to 3% or 5%. Find the revenue required to pay the debt and compare to that in 5. So I'll find the revenue in this one and compare it to this one.
Sorry.
Yes?
Hello. Okay.
Yes,
Sorry, I'll take you back to the last computation. Sorry about that.
okay.
I think I didn't get the same answer as you for the
Yeah.
116.94. So I don't know where I went wrong.
Okay, so I was saying 1.5, the numerator, right, times 350 first. 1.5 multiplied by 350 times 0.05. This part here first. We're talking about this part first here. This part.
Okay, so for the top part, for the top part, yes, I got 26.25, just like you.
Yes. So I said this part here. This part. We found this part earlier on. This part. So when you had the first question, Here.
Okay.
This
I think it's 0.427785.
0.427785. Okay, maybe because of rounding off, but then
0.427. Okay, yeah, so I was just writing.
okay. All right, so this link is going to cut shortly. So just rejoin once it cuts. It's about to cut shortly. Just rejoin once it cuts. So I'm saying here, when you do all that, we just extract what was here. Just pick up what was here directly. This part here. That's what it picked up here.
Okay. All right. Now when you go back to the computation you're making,
Yes.
where there's the 26.25, we're
Yes.
dividing it by the 0.2566. For me, I put 71. Just divide that again.
28. This is
Just
88.
divide.
Sorry. This is 88.
Yes. Now
0.288.
just try. Yes,
Okay.
just try and divide it.
So it's giving 90.9.